also going to be discussing what the principles and the processes involved in scaling a fintech company. And just for time purposes, I'm just going to be jumping right in with Kevin, Mr. Wonderful. Of course, you have seen thousands of business pitches throughout your time at Shark Tank. And I must say, a lot of them are, if I can call them, out of the box. So I have been binge watching Shark Tank in the last few weeks. I call that research. Some of them are bubbly blaster, an alarm clock that can wake you up with the smell of cooked bacon, to name a few. So let's just say that in comparison, fintech may not be, the most exciting thing that you see. So what would make a pitch for a fintech company on the show get your attention?
Two attributes. They knew their customer acquisition costs and could prove it over at least a 2-year period of time, or at least 18 months, so they knew the attrition rate, and that had they adjusted their cost of compliance to the new rigorous platforms of compliance. The reason that 8 out of 10 fail over 36 months, and I've seen many, many fintech deals in all kinds of verticals, is they're never able to get their customer acquisition costs below lifetime value within 2 rounds of funding. So everybody's optimistic at the beginning. They generally say, look, let's go in at a pre-money of $5 million, raise $2 million, whatever it is. They burn that out pretty fast and they go for another round. And if they haven't proven customer acquisition, so let's say the first 10,000 accounts, well, today you can't even get funded. And so, but at a period in 2020, when a lot of these came out, they got a second round, slightly up sometimes, maybe at 8 million or whatever, but then they went to 0 when they never got customer acquisition. And that was prior to the regulators doing what they've done since, the FTX fiasco and of course this week and the whole, it's been a pretty rough run.
Yeah, we're going to get to FTX and we're going to get to regulation. But John, I want to move on to you here. Do you agree with Kevin? And obviously, just to give a bit of background about John, he's helped several fintech startups, most of which had over $1 million investments through our crowd. So how did you build or scale these startups in order to secure this level of investment? And do you share Kevin's opinion?
Look, I run an interesting company which is half fintech, half investment platform. And so we're the cross of venture capital and financial technology. The premise behind what we do at our crowd is, how do all of you not just enjoy watching Kevin and his partners at Shark Tank and imagine, wow, that would be cool to invest in that company? How do you actually get to invest in venture capital worthy companies together with co-investors like Sequoia or Kleiner or whatnot? And for most people, that doesn't work, right? In other words, all the good deals are locked up. All the good deals are going to people like Kevin or me, and you guys aren't invited, right? In other words, it's a closed party.
I tell you, I can't sleep at night.
And so I think the idea, and it's happening now more and more, is to break this closed club up, okay? Let everybody in, okay? But do it in a way that you won't just lose money, but that you can make money and get venture returns, which are what the big boys do. So at our crowd, we're managing about $2.3 billion. We have 450 portfolio companies across a bunch of sectors, fintech being one of them. And our idea is to do venture the right way, with diligence and checking, everything from acquisition costs to your return on investment. But on the other hand, allow individual accredited investors, you have to meet with the regulators' regime and their demands. And then you can get in for a specific deal for $10,000, or you can actually get into venture capital funds, top quartile funds, for $50,000. And that's turned out to be a winning model, and we're excited at the future growth of that.
We're going to talk about regulation more in depth in a minute, but since we're talking fintech, I have to talk about arguably the greatest fintech invention, which is cryptocurrency. You've mentioned FTX, so we've seen the crypto's fluctuating nature, but it's still a force to be reckoned with for many. You just mentioned that when you invest in a startup, 8 out of 10 times, you lose your money. You lost about $18 million with FTX, and that's a lot of money. So what are...
I try not to think about that too often.
Sorry, I'm
But thank
reminding
you for
in
bringing
front
that
of
up. Thank
about
you.
100 people. Anyway, the question here, and I think this is what people here would like to know, are for you, what are some of the lessons learned, if you will, that you will keep in mind the next time you invest in any fintech company? Let's just not confine this to crypto.
Well, the FTX experience and now most recently the Binance experience doesn't change the potential of digital payment systems. And so, unfortunately, it sets it back from the regulatory environment because if you were skeptical about crypto prior to FTX and Binance, you have a lot more fuel to burn now. And certainly the US regulator, as you can see, with the litigation going on with the remaining US exchange, Coinbase, that's a difficult situation. I think Coinbase has gone to bat against the SEC 3 times, struck out. This will be the 4th time. I anticipate they'll strike out again. You can't beat the regulator. That's the lesson I learned. And remarkably, when we were here last year, and I just think this has got to be just pure luck, we were talking about the fact that, between FTX and Binance, they own 97% of the market of cryptocurrencies and digital payment. And the chance that somebody new could come and gain share was impossible. And here we are now, and last night, M2. I mean, how crazy is that? Because they now stand to siphon off some huge percentage of what's remaining because they're the only compliant player standing, and they just did this. And so for me, it's look at the volatility of what's occurring here and the opportunity too, because the ADGM and the regulator here has been saying for 3 years during the crypto volatility, it's all about compliance. And M2 now is the only one that has the rigor and the capital behind it and the technology to pull this off. So I've been racking my brain trying to figure out, how do I get a piece of this? Because I got killed on FTX. I got absolutely screwed on Binance. This is the one I got to invest in because I keep going till I'm right. That's how it works, because I know this is going to work for somebody. And it's Phoenix Technology that owns 30% of M2, which is private, and they're going public on the ADX. So yes, I'm going to buy that.
And speaking about the regulatory landscape, I mean, you were not a believer in the crypto world beforehand, but when the regulatory landscape changed, and you have said this before, when more countries were starting to adopt this new kid on the block, let's call it, at that time, that's when you started investing. Yeah. Was regulation your turning point? Is it enough now? Is the regulation that's happening now enough, or does more need to be done in your view? Because the worry over a decentralized financial system is still very much there. So,
well, it's a very simple answer. I index for pension and sovereign wealth. I create indices. OUSA is an index. These are things that AlpSpot, my indexing company, but I know the demand for just take Bitcoin, the granddaddy digital currency of them all. Most sovereign wealth funds would allocate 100 to 300 basis points for just that asset if they could, on a compliant basis, on an exchange that was compliant, and an exchange that had the infrastructure to allow them to report on a 24-hour cycle, because most mandates only allow up to 5% in any one position, 20% in any one sector, and the software has to push up. Now, that was what FTX was trying to do. That's what Binance was trying to do, to get linked to financial institutions. They never got there. I'm hopeful that M2 will pull that off, because then they will get the 300 basis point allocation, which I estimate is $1 trillion. Yeah. Because they don't touch this stuff yet. And so we're at the beginning of something very interesting. I'm sure there'll be other competing exchanges coming, but just by luck, or maybe hard work or a combination of both, here they are when the biggest competitor kills itself. That never happens, but it happened here.
All right, we're going to move away from crypto a little bit, but still staying on the regulation part of things, because I think it's very important. So, John, you obviously operate in many countries. The regulatory landscape is a very big determinant of how certain fintech technologies get adopted, whether it's cash wallet or crypto or credit cards, whatever it is. So when the banking power is taken to a large extent from the hands of banks, obviously tension arises. And this will affect whether a VC will invest, because depending on regulation, some things may work in Ecuador, but may not work in Brazil. And, different countries have different regulations, obviously. So is how a fintech company can navigate that if it's operating on a global level? And in your experience, how can they navigate it?
Look, I think it's, you know how the old Facebook had a description of a relationship and they often said it's complicated.
Yeah.
That's sort of the way that fintech entrepreneurs work with regulators. Because on the one hand, if you are going to try to start a company and you're going to wait to launch your product or service and not get into the market with your great new idea before everything is completely buttoned down without any kind of risk or chance of you screwing it up, you're not going to make it. Okay. In fact, I'd be hard pressed to think of an example of a company. I mean, when I went out and pitched my investors to build our crowd in the beginning, and I said, look, I'd like to build a platform that allows you to select a company. Okay. And if you're a accredited investor, you should be able to put money to work. Okay, in doing that, according to what's called Reg D in the US and whatnot. And I had friends who, not jokingly, said, look, John, I know you're going to end up in Leavenworth, which is the federal penitentiary in Kansas. We'll bring you kosher food. Okay? In other words, people were certain that I was headed to some kind of horrible thing. The reality is you have to be smart. You have to study the material. And most people don't have tolerance. They don't do this. The problem is you go to lawyers and you'll get 10 lawyers and you'll get 10 opinions on this stuff. There are very few consensus matters, especially when you're breaking through. I remember I was a seed investor in a company called the Lending Club, where I got in literally in the very first round. It peaked and I got out near about a $9 billion end valuation. But they did something very smart. They started lending money to small borrowers early. The regulation wasn't there, but then at a critical point, they shut down the platform and they made themselves good with the SEC and whatnot. They came back fully regulated. It worked. They made money. When we started, it was just in our business, it was just the beginning of what's called the Jobs Act, where all of a sudden they were regulating what they called crowdfunding. Now, we're not really crowdfunding. We're like venture capital investing democratically, but it turns out that we operate under the same exemption that a normal venture fund runs because we act like a venture fund. And you simply have to be able to deal with complexity. It is complicated. And once you do get regulated, and today, for example, we're not just regulated in the US and in Europe and in the UK and in Hong Kong and in Singapore and here at ADGM and a whole bunch of other countries. It's a moat. Come get us, okay? Start competing with us. We've been at this for 10 years, building this knowledge, building the data, okay, which has been audited and reviewed by these regulators. And it's not just good for them, it's good for the consumer because the consumer doesn't want crooks, okay? You can, push the envelope, but if you're a crook and you're, a criminal, you're gonna go to jail, and that's what's happening. Okay, yeah. And I think that regulation is something which good entrepreneurs can get behind.
Great. Let's talk about the investing side of things. Kevin, on the show, obviously, you use your gut feeling a lot of the times to see if this pitch is worth investing in or not. But are there other signs, in your view, that an investor or a venture capitalist should look for when investing in a fintech company? And how can fintech companies or entrepreneurs present themselves as just that?
Well, I have to share some data with you. After 16 years, let's just take the Shark Tank as an example, which has the benefit of 100 million eyeballs watching it in syndication. So it generally reduces customer acquisition costs dramatically. That's the secret sauce of it. But within the Sharks portfolios, typically they do 12 to 17 deals a year, close half of them. And then, and every year we collect, we have big teams now. We've been doing it for so long, so we often collaborate in diligence afterwards or whatever. But, and this is, maybe it's you think you know. You think you know out of the 10 or 12 you're closing, the 3 you're going to make all your money on in the next 3 to 5 years. And I can tell you with certainty, you know nothing. You have no idea what's going to happen. And 5 years later, 7 years later, from that vintage batch, some crazy outcome occurs that pays for all of your mistakes. And I've stopped trying to guess or trying to find attributes. I just diversify. I do 10, 12, 14 deals, and maybe 2 of them end up being 1,000x. And we've had some really big outcomes on crazy stuff. The one I talk about from last year a lot is base pause, cat DNA testing. Why would you spend $29 to test your cat's DNA when you can buy a new cat for $5? I never understood that. And yet Anna, the entrepreneur, was so compelling in her, and I was the only one investing. I thought, okay, it's just great TV and I'll write it off later. She sold that money to a pharma pet care division, that company, for so much cash, the show had to do an NDA that they would not disclose the purchase price.
Wow.
It was insane. And I just said to her, and she's very wealthy now, I said, I love cats. I love cats. I mean, that's the outcome. And it paid for like 3 seasons worth of mistakes.
Yeah.
And so I tell everybody in venture capital, I'm glad you brought up equity crowdfunding, because the Jobs Act created Start Engine. I'm an investor in that. And we put out about $300 to $400 million a year with equity crowdfunding. And it's actually flat this calendar year when real VC money is down 30%. Mm-hmm. So this democratization you're talking about is very important, and it's working, and the outcomes are the same. But I encourage everybody, if you're going to do venture deals, you got to do 7 or 8, because you have no idea what you're doing.
John, I want you to
jump in on this.
Yeah.
Kevin is so right. I think probably you've got to multiply it a little bit. Diversification is your only answer in venture capital. But you've got to look at it from a multi-vector standpoint. Don't just diversify in numbers, right? You need shots, but I would look at it as shots on goal, okay? You're not shooting penalty shots. You're shooting from a little bit farther. It's harder to hit, okay? But if you don't take 10 shots or 15 shots, you're not going to do it. But the beauty here is that when you hit the goal, it doesn't just return 50% on your money or return twice your money. You can get 10s or 50 or 100, or if you're Mr. Wonderful, you can get 1,000, okay?
It's happened, yeah.
I know, but the reality is that you have to have those shots. But in addition to that, you have to, in my opinion, diversify according to sector, because sectors go up and sectors go down, and you can be the smartest kid on the block and you're investing in a bad sector, you're toast. Okay, there was a time there where, if I can mention it here, cannabis investing was super hot. Everybody was doing it. Okay, if you were foolish enough to go in and invest then, you ended up losing your money. You literally became toast, because the whole sector crashed and became, completely commoditized. Autonomous driving. Okay,
yeah.
Back in 2016, 2017, people were, I think, smoking that cannabis. They were absolutely convinced that there was going to be autonomous driving in just a year. And I was guest hosting on CNBC, and I had the CEO of Audi who told me we're going to be having fully autonomous cars in 2017 and 18. And I said, impossible, it's not going to happen. He said, watch. Well, we're waiting. Cruise just shut down. So if you try to choose a sector and you bet on only that sector, mistake. Diversify according to sectors. Yeah. Diversify according to stages. okay, early all the way to late if you can, because you never know about vintage. Like in wine, venture capital is critical in terms of the year. I happen to think that this year's vintage is awesome because prices are down. As Kevin spoke before, venture capital prices are down at really half price. So every smart investor knows you buy cheap and sell high, you're going to make money. So you have to diversify shots on goal, but diversify according to sectors and vintage.
This is great advice for the investors. I know our time's up, but I wanted both of you to give your advice also to the entrepreneurs, the other side of the coin. How can you present your fintech company to people like you and get an investment?
Be able to articulate the opportunity in 90 seconds or less, explain why you can execute on the plan, and you better know your numbers. If it's going to be fintech, you better know your CAC, your ROAS, and all of the numbers that all investors now understand that define success or failure in fintech's a tough space.
Yeah.
It's a tough space.
And John, obviously you're not in the show business, so the time limit will not be there for you, I'm guessing.
No, look, I actually agree with Kevin on this. When you're sitting and pitching somebody, you've got about 90 or 120 seconds before they're bored.
Yeah.
And you'll see it. They'll pull out their phone. They won't look you in the eye. And that meeting is not going to go well. You have to make sure that your pitch is crisp, that you really have thought about it. Okay. And then you have to deliver the message with passion. If you are boring, or you are simply one of these monotone persons, okay, it happens. Not everybody is, a TV star, okay? You can project that way, then go find a partner who can, okay? Because the bottom line is that everybody is seeing, at our crowd, we select between 1% and 2%, which is a very high percentage of the deals that we see that we actually invest in. Most people are investing in less than 1%. So you walk in to pitch an investor at a reputable or significant fund, you've got 1 in 100 chance. You've got to deliver that message well thought out and with a lot of passion.
Ladies and gentlemen, Kevin O'Leary, John Medved.